Every time you buy a coffee, book a hotel, or pay for something online, two companies can make money without selling you anything: Visa and Mastercard. They don't need to manufacture phones, they don't need warehouses, and they usually don't even lend you the money. They simply built the highways that money travels on, and every time money moves, they get paid. Every day, billions of people pull out a card and make a payment: a coffee, a hotel room, a plane ticket, a new phone. You tap your card, the payment is approved, and within seconds you walk away. But behind that simple transaction, something much bigger just happened. Your payment traveled through banks, payment processors, and one of the most powerful financial networks ever created, Visa or Mastercard. And here's the surprising part. Visa didn't sell you the coffee, Mastercard didn't manufacture your phone, and in most cases, they didn't even lend you the money. Your bank did. Visa and Mastercard built something far more powerful. They built the highways that money travels on, and when trillions of dollars move across those highways, they can collect fees from the enormous ecosystem built around them. One transaction might generate only a tiny amount of revenue for the network, but multiply that across billions of payments in stores, airports, hotels, restaurants, and websites around the world, and suddenly, those tiny amounts become an enormous business. This is how two companies became deeply embedded in the global economy, without owning most of the banks, without lending most of the money, and without you thinking about them every time you pay. But to understand how they became so powerful, we need to follow what actually happens the moment you tap your card. Chapter 1. What happens when you tap your card? Imagine you're buying a $10 coffee. You tap your Visa card. It feels instant, but behind the scenes, a conversation between several financial institutions begins. First, the coffee shop sends the transaction through its payment provider. The request reaches the merchant's bank, known as the acquiring bank. From there, the transaction can travel through Visa's network. Visa doesn't decide whether you can afford the coffee. Instead, its network helps route the request toward the bank that issued your card. That bank checks your account or your available credit. Then it makes the decision, approved or declined. That answer travels back through the network until the terminal in front of you says, approved. All of this can happen in seconds. And this distinction is extremely important. Visa is generally not the bank lending you the money. Mastercard isn't either. They're primarily payment networks connecting different parts of the financial system. Think of them like highways. Banks are the cars, money is the traffic, merchants are the destinations, and Visa and Mastercard help operate the roads connecting them. That's why their business model can be so powerful. They don't necessarily need to own the money to make money when it moves. Chapter 2. The money machine. So, where does the money come from? When you pay $10 for a coffee, the merchant doesn't necessarily receive the full $10. Several different fees can exist inside the payment process. And this is where one of the biggest misconceptions about Visa and Mastercard begins. You've probably heard that they simply take a percentage of every purchase, but that's not exactly how it works. A significant part of the fee paid by the merchant can ultimately go to the bank that issued your card. This is commonly associated with the interchange fee. The payment processor and acquiring side can also receive their share. Visa and Mastercard operate in a different part of this ecosystem. They earn money from the enormous payment networks connecting these institutions. They can charge fees related to payment volume, the processing of transactions, cross-border activity, and additional services provided to banks, merchants, and other financial institutions. So Visa doesn't need to make a huge amount from your individual coffee. It needs something much more valuable: scale. One coffee means almost nothing. 1 million transactions become interesting. Billions of transactions across hundreds of countries and territories become an extraordinary business. And because much of this infrastructure is digital, the economics can become extremely attractive as the network grows. Visa doesn't need to manufacture another physical card every time someone buys a coffee. Mastercard doesn't need to build another store every time someone books a hotel. The network already exists. More transactions can flow through it, and more payment activity can mean more revenue. This is one reason investors have historically been attracted to payment networks. They're not simply betting on people buying more things. They're betting on something much larger. the continued movement from cash to digital payments. Chapter 3. The moat almost nobody sees. Imagine creating a new payment network tomorrow. You could build incredible technology. You could charge lower fees. You could even design a better looking card. But you'd immediately face one enormous problem. Why would consumers use your card if stores don't accept it? And why would stores accept it if consumers don't use it? This is known as a network effect. Visa and Mastercard spent decades building both sides of the network. Consumers want cards that work almost everywhere. Merchants want to accept cards carried by millions of customers. Banks want to issue cards their customers can use around the world. And every new participant makes the network more useful for everyone else. That's incredibly difficult for a new competee, because Visa and Mastercard aren't simply competing with technology. They're competing with decades of infrastructure, relationships, trust, and global acceptance. That's their real moat, and it explains why even some of the world's largest technology companies haven't simply replaced them. Take Apple Pay. When someone adds a Visa card to an iPhone, the phone may change. The payment experience may change, but underneath, the transaction can still rely on the existing card network. The same is true for many digital wallets. The interface evolves, but the financial rails underneath can remain remarkably familiar. And that's what makes Visa and Mastercard so interesting. They don't necessarily need to own the wallet in your pocket, as long as they remain part of the infrastructure behind it. Chapter 4. Can anyone replace them? For decades, Visa and Mastercard have built one of the strongest positions in global finance. But that doesn't mean they're untouchable around the world. Governments, banks, and technology companies are building new ways to move money. Instant bank transfers are becoming faster. Digital wallets are becoming more popular. Fintech companies are trying to remove friction from payments. And cryptocurrencies introduced an entirely different idea. What if money could move globally without traditional card networks at all, at first? That sounds like a serious threat. If consumers can send money directly from one bank account to another, why would they need Visa or Mastercard? But replacing these networks is much harder than it sounds, because payments aren't only about moving money, they're also about security, fraud prevention, dispute resolution, global acceptance, and trust. A tourist from New York can land in Paris, walk into a restaurant, tap a card, and expect the payment to work. That simplicity hides decades of financial infrastructure, and building an alternative that works at the same scale is enormously difficult. But perhaps the biggest threat doesn't come from technology, it comes from governments. Regulators around the world continue to scrutinize payment fees and competition. If regulations force fees lower, the economics of the industry could change. So, Visa and Mastercard face a strange challenge. They need to remain essential without becoming so powerful that governments decide they are too expensive. Chapter 5. Why Wall Street loves this business. And this brings us to the investment story. Why have investors historically valued payment networks so highly? The answer starts with their business model. Visa and Mastercard don't need to manufacture millions of physical products. They don't need giant inventories sitting in warehouses. And compared with traditional banks, their core network businesses generally aren't built around lending consumers enormous amounts of their own money. Instead, they operate infrastructure, and infrastructure can become extremely powerful when billions of people depend on it. As economies grow, people spend more. As cash disappears, more payments become digital, and as international travel and e-commerce expand, money crosses more borders. Visa and Mastercard can participate in those trends without needing to predict exactly which smartphone, which airline, which retailer, or which restaurant will win. They don't necessarily need to pick the winner. They want to operate the network connecting the winners. It's similar to owning a toll road. You don't care which car becomes the world's best-selling car. You care that more cars keep using your road, and that's the investment thesis in its simplest form. But there's also a danger. When investors recognize an exceptional business, they may be willing to pay an exceptional price for it, and even a great company can become a bad investment if you pay too much. The toll roads of money. The next time you tap your card, watch what happens. You'll hear a beep, see the word approve. and probably never think about it again. But behind that 2-second moment, banks, merchants, processors, fraud systems, and global payment networks are communicating almost instantly. Visa and Mastercard became giants not by selling us the things we want, but by building infrastructure between us and the businesses selling them. They don't need to own the coffee shop. They don't need to build the hotel. They don't need to manufacture your phone. They simply need one thing: for money to keep moving. Because in the modern economy, owning the road can sometimes be more valuable than owning the destination. This is Behind the Money, and we'll see you in the next episode.